most people who manage money are in their 40s or 50s. Wireless was a new technology, and I was in my 20s at the time.
Right.
And I quickly learned young people adopt technology.
He noticed a key pattern. Young people adopted disruptive innovations long before the investment community caught on. This applied to wireless, social media, Google, Facebook, crypto, and most recently, artificial intelligence. The lesson was clear. Markets often underestimate the transformative impact of new technologies, especially when viewed through the skeptical eyes of older, more conservative investors. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comment section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
Equity strategists are macro people that are economists. And then they may follow economic data, but then they build what I would say is a stylized model of the economy and the stock market using indicators. They might say, I'm using PMIs or, liquidity or earnings. But we approach the world at Fundstrat more as the stock market is the composite results of the 500 names in the S&P. So I always think of it as these are individual companies that comprise the index. And the reason that evolution came for us was that when I was doing wireless, I had to do quite a lot of thematic work because it was a new industry. Many of my clients never heard of wireless, and there was also a very big age difference. Most people who manage money are in their 40s or 50s. Wireless was a new technology, and I was in my 20s at the time.
Right.
And I quickly learned young people adopt technology which most investors don't understand and they're skeptical of. And I witnessed it. We've witnessed it many times since, whether it's social media and how people have dismissed Google and Facebook, or how people have missed crypto, or even how people have missed AI. A lot of people were dismissing AI just 2 years ago, saying it's not going to work. People are too optimistic, and look at AI now. So I've learned to look at the world through younger people's eyes. And so much of the work I did as a technology analyst was thematic, large think pieces I would publish. And I was at JP Morgan at the time, and they found it as the work I did was helpful to teach other analysts. So they had asked me to become the mid-cap strategist in around 2006 or so. Around that time, JP Morgan opened up a new research office in India, which was underutilized. It had 40 analysts. And so one of the projects I thought of doing was to look at bankruptcies, because wireless companies were going bankrupt. And so I sort of put this task list together to go through over, I think, 4,000 or 5,000 bankruptcies since 1970 to follow what happened to these companies. And it turns out that many of these companies that come out of bankruptcy come out much stronger. And so we wrote a book called, or a white paper called Chapter After Chapter 11, which became very popular, but it was basically recommending certain stocks as they came out of bankruptcy. So I was a mid-cap strategist for a while, doing bankruptcy research and wireless. And then in 2007, they asked me if I wanted to take on the larger role as the head of macro strategy. And that's when I started to do it. And sorry, it's for a long-winded answer, but at the time I was doubtful I should do it because I still viewed myself as someone who looks at 10 Qs and picks stocks.
Right.
And I didn't think anybody could actually forecast the stock market itself. But what I said was I would study it, and I did, and I came up with our own approach, which included those first principles I mentioned. And we started to write about the stock market in that way, which was very different than most strategists. Because most strategists will be like, oh, the ISM's at 45, which implies S&P earnings growth of X, and then you just throw a PE on it, and that's where the target is. And I could never believe that would actually work. So we come up with a very different approach. We view this as stocks, what stocks could lead, and then how does that drive the value of the index.
Got it.
The mistake most people make is putting too much credence and weight on PE. Okay, so in other words, when people talk about the stock market, you'll hear a lot of experts say, oh, well, the PE should only be 18 times or 15. times this earnings, and therefore the stock is a sell.
Right.
I never understood it because number one, in Wharton, when I took all my classes on finance, no one ever actually said PE was something tangible. PE is a residual calculation.
Right.
You have the price of a stock, and then you have a fundamental metric. Now, it could be earnings per share, it could be cash flow per share. What we never know is the reality is which earnings period are we looking at? Are we looking at last year's earnings or earnings 2 years from now or 20 years from now or next quarter? Are we more caring about cash flow or earnings or EBITDA? And then what's the right risk appetite? Because a PE in a world of 10% inflation is different than a PE in a 2% world. A PE is different if there's high cost of money or high risk aversion. So I always view PE as a residual calculation and actually not that important. And so when we think about where markets can go, we tend to think of it as how much we do stick with an earnings concept. We need to know what earnings power is.
Right.
But we're not anchored by it because earnings delivery can change because of concurrency, labor cost, margins, government policy, buybacks. So we think of earnings as sort of a base case. And then we sensitize it and ask, could earnings do better than expected or worse? And then we think about what that would mean to the PE. So we're not as anchored to the idea that, oh, hey, the forward earnings of the S&P is at 19 times, which it is today, the index, so it's a sell. Or someone will say small caps, PE is 24 times, so it's a sell. The reason I don't like that concept is that, one, there isn't really S&P earnings per share. It's the earnings of all these companies. And in the S&P today, for instance, the Mag 7 trade at 29 times earnings. So it makes the market look expensive. The median PE in the S&P is 17 times forward earnings.
Right.
And that's not at equilibrium. It's a moving target because earnings could do better or worse. The median PE in the Russell 2000 is 11 times. Now, over 30% of the Russell 2000 doesn't make money, but the vast majority of those that don't make money are biotech companies, and then there's a lot of regional banks, but regional and REITs, but regional banks are doing poorly because of monetary policy. So I'm not as constrained about what the Russell PE should be because I think the earnings could move a lot more.
So while markets making new highs may feel unsustainable to some, Lee argues that in a true bull market, markets are supposed to make new highs. A better signal of a top would be when traditionally low multiple industries, like banks or consumer staples, suddenly trade at frothy valuations. That's when irrational exuberance takes hold.
The way what you're describing are rolling recessions, right? Because pockets of the economy are contracting, but it's not large enough to cause the entire economy to be in a contraction cycle.
Right.
I think business cycles are very mysterious. I mean, if you use the NBER's dating system for recessions, and from 40 to 1990, economies were really frequent. In fact, the U.S. probably spent close to 40% of the time, 30 to 40% in recession. So in other words, in 10 years, you have 4 of those years are a recession. I mean, which is a lot of the time. But it made sense. Back then, manufacturing, which is super cyclical, was a large part of the economy. And as you know, there's the bullwhip effect around manufacturing, which leads to over-ordering and busts. So the economy, U.S. economy was a boom-bust because manufacturing was such a big part of the business cycle. Since the 80s and 90s, the U.S. economy has evolved, and globally it's evolved. First, it's because the service economy has grown. Now, service is an encompassing word. It means healthcare, financial services, tech, transportation. But the service economy itself is less cyclical. It's steadier.
Right.
And government spending has become a larger share. So manufacturing, which has gone from being the largest share of the economy, is now arguably the smallest share.
Right.
and therefore we should have fewer business cycles, which has actually been the case. Now, that business cycle volatility has been pushed to other countries which do more manufacturing. That's why Asia is more of a boom-bust economy. And believe it or not, Europe is primarily a manufacturing economy. Germany itself is one large manufacturer. And so Germany and Japan and Asia spend twice as much time in recession as the U.S. So the U.S. is essentially a consumer economy with a huge amount of accumulated wealth. The household net worth in the U.S. today is about $150 trillion. Let me just put that in perspective. The U.S. GDP is $25 trillion. So U.S. households have saved or have a net worth that is roughly 6 to 7 times the U.S. economy.
Right.
We could shut down the entire U.S. economy and we'd still have GDP because the U.S. consumer has $150 trillion of wealth. That is by a country mile. We are the wealthiest. The U.S. is the wealthiest nation. And I think that's why the business cycle is less tied to economic activity and maybe even more sensitive to the stock market. So it's the trade-off is, of course, the stock market has a psychological impact on the economy. So if we have a stock market crash, we're almost guaranteed to have a recession. Other countries could have a stock market crash and it wouldn't affect their economy because very few people own equities. So that's, I think for someone who's looking at the U.S., that's something to keep in mind. And do I think the U.S. should have a recession now? I don't think so. One comprehensive measure is how much debt has been borrowed. U.S. companies have not borrowed a lot of money. It's been expensive too. And the debt that they have is low cost because they locked it in. U.S. households are underlevered. A measure is called the debt service ratio by the Federal Reserve. It's at roughly 10% of disposable income. Past recession peaks, meaning when leverage gets too high, it gets towards 14 or 16%. So consumers could borrow a lot of money. The only part of the economy that's over-levered is the U.S. government. But the U.S. government has never triggered a recession because they had too much debt. They could trigger a currency collapse, but not a recession. Many people think there is, and there logically should be, but we know many instances in many countries where you've had asset prices rise and it has not triggered inflation. In fact, you might even have some countries that are suffering from deflation. Inflation, which is a mysterious phenomenon, is best traced to, I think, and the Fed is acknowledges, to a change in how consumers and businesses expect price changes to take place. So if a consumer owns a lot of stocks and it's gone up, it doesn't mean that they expect the price of a car to go up or the price of a house. House and the car, by the way, is 60% of the CPI basket. So if those aren't going up, then is it hotels, restaurants, clothing? These aren't necessarily tied to stock prices. They are tied to wealth and spending ability, but the flip of that is the stock market isn't held by everybody. Most of the wealth of the stock market is held by a small percentage of households. So asset prices making new highs is not the sign of a top. In fact, in a bull market, you'll be making new highs all the time. You know what I mean? Like,
Right.
if you're in a bull market for stocks, it's always going to make a new high. So you can't say it's topping. I would say, to me, when the last stock that should never have a high multiple gets a high multiple is really when you get a top. And, when I see financials trading at 10 times earnings, a lot of staples have derated. I mean, small caps at 10 times earnings, I'm not sure it's a top. And so I can't speak to how they got to their conclusion. I won't doubt that they have done some work and they can show some charts. But I would just point out that cyclically adjusted PE, if we look at the chart, you would have actually sold the S&P already in 2014. So you would have been out of the market for the last 10 years. because you revisited all-time highs on CAPE. So my guess is that someone who did this analysis in 2014 at an all-time high CAPE would say the next decade would have subpar returns, and the S&P has been 13% a year.
Right.
Second, I think that's another example of what I would call someone doing high-level analysis to explain stocks. Does this analysis capture the impact for AI? Does it capture the changes that could come with onshoring, the changes in government policy around cost of energy? Does it capture demographics? None of those are reflected in a CAPE, and none are reflected in concentration. So I'd almost say that someone who would lend credence to that view is giving up all the discipline about equity investing in the first place. I mean, just as an observable fact.
Right.
That would be like someone saying, Tom, forget everything you know about investing and just look at one metric. But here's another intuitive way to look at it. If someone says the market's going to grow 3% a year, well, what will earnings do? Are earnings going to grow? Well, let's say GDP is 3 real, so that's nominal of 6 plus buybacks, so you have 9% earnings growth. So are they saying PE would contract 6% a year? So the PE is at 17 times now? Well, in 10 years, the PE would be down by 70%. So they're saying the PE goes from 17 to 10. Okay, so if PE goes to 10 and earnings grow at 9, we'll have 3% total return. But is that a reasonable base case? I mean, I don't know.
He also challenges the math. If GDP grows at 3% real, 6% nominal, plus buybacks, earnings could grow around 9% annually. For Goldman's forecast to hold true, the PE ratio would need to collapse from 17 to 10 over the next decade, a 70% contraction. Is that realistic in a world of advancing technology, favorable demographics, and government support for growth? Lee thinks not.